Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. Our first question is from Beth, who says, I'm close to retirement. I've been waiting for interest rates to go up, but it sounds like you don't think that's going to happen. So should I lock in now? All right, Beth, well, I'll answer it in two ways. I'll first start with kind of like my crystal ball answer. And I don't like to give crystal ball answers because you don't know what's going to happen. But can rates edge up a little bit? Sure. You know, with the concerns about inflation, maybe other governments not so willing to buy our dollars now, or a government bond, you know, the 10-year government bond, it could creep up a bit, sure. But you plot that against the probability of recession, right? The Fed moving to lower interest rates, maybe the Fed going back to quantitative easing like it had done for a good part of a decade or a decade and a half with the kind of the starting of the financial crisis where again, you know, they don't set long-term rates really, right? But they can buy government bonds and drive up the price because of the increased demand and drop, you know, increased demand drops the yields, right? So they can manipulate long-term rates. So when you look at all that, there's just a greater chance rates are going to go down than go up in the next year or two, right? So yeah, you know, can you lock in a little bit? Sure. But is it worth getting greedy, right? Because the real answer to your question is, if you're really close to retirement, like you said, you know, why take the chance? If you can lock in at 4%, that's a lot better than 3%. And you know, that's a third more income. And it doesn't take long for rates to go down by 1%. The Fed just starts, you know, lowering rates. Let's say the first time they lower rates by 0.5%. 2 months later, they can lower by another 0.5%. Long-term rates come down even more because they overreact. Long-term rates are forward-looking, so you can find 1% shaved off the rates real quick. So if right now you can get 5.5% in bonds or bond-like instruments, you can go from 5.5 down to 4 with the snap of a finger, right, in 6 months. And you know, even that's 25% reduction in your income. So is it really worth the wait to get a couple extra dollars? This is particularly important for retirees who are building an income floor for their retirement. Remember, when you're no longer bringing in a paycheck, you need reliable income sources to cover your essential expenses. Now, having a portion of your portfolio locked into these higher interest rates now can provide that stability throughout your retirement years, regardless of what happens with future rate movements. I would say, given, you know, where you are in your proximity to retirement, you know, most likely not. Right now is a great time to start locking in some of that yield, and it doesn't mean, again, you have to lock yourself out of growth potential, right? If you want to maybe not technically lock in the yield on all of it by buying bonds or preferreds, and you want some common stocks where you have some potential for them to go up in value or some potential for the dividend to go up in value, then you can still have some upside. You're not locking it in completely, but at least you've created a bit of a baseline for yourself with those interest rates and with those potential retirement income payments. The strategy I often recommend for people in your position is to create what we call a bond ladder, right? Buying bonds with staggered maturity dates. This gives you both the security of locking in today's rates while still having bonds maturing periodically if rates do happen to move higher in the future. So again, best advice, don't get greedy and try to time it at the actual peak. Very, very few people can do it. And frankly, those that do, there's a big luck component to it. Thanks so much for that fantastic question. As always, if you would like to send in your question, you can do so. You can email them to poolelocke@poolelocke.com. Moving on to our second question from Matt. He asks, is Bitcoin a good inflation hedge? All right, Bitcoin's been doing well. Matt, thanks for your question. Whether or not Bitcoin really serves as a good inflation hedge, especially in the context of investing for income in retirement. It's a topic that's really garnered a lot of attention. So let's go ahead and just unpack it a little bit further. Bitcoin, often referred to as digital gold, has been touted by some as a potential hedge against inflation. However, it's important to differentiate between perception and, practicality when it comes to its role in a retirement portfolio focused on income with reduced risk and reduced volatility. First, let's address the comparison to commodities like gold. Now, while commodities like gold can indeed serve as inflation hedges due to their intrinsic value and the fact that their prices often rise with inflationary pressure. So Bitcoin operates differently. Unlike commodities that have physical use, or industrial demand driving their value, Bitcoin's value proposition primarily rests on its status as a digital asset and store of value. This distinction is crucial because it means Bitcoin lacks the underlying demand dynamics that support traditional inflation hedges like gold or agricultural commodities. Now, moreover, Bitcoin's price volatility and speculative nature introduce additional risks for retirees seeking stable income. Unlike income-producing assets such as bonds or dividend-paying stocks, Bitcoin's price movements are driven largely by market sentiment, regulatory developments, and really just investor speculation. Now, this speculative nature makes Bitcoin susceptible to significant price swings, which can undermine its role as a reliable inflation hedge within a retirement income strategy. Now, I've actually owned some Bitcoin, and I've sold some of it recently, a portion of it. I recognized its potential as a speculative investment, and I concluded that its role as a stable income generating asset in retirement was limited, right? Now, without the underlying earnings or industrial demand that supports other assets, Bitcoin remains primarily a vehicle for investment speculation rather than a reliable hedge against inflation over the long term, right? Because that's what we're trying to do. So in summary, while some may view Bitcoin as maybe a psychological hedge against inflation due to its perceived scarcity and digital nature, its practical utility as a reliable inflation hedge for retirement income remains uncertain. Right? For retirees focused on income stability and reduced volatility, diversifying into assets with proven track records of income generation and inflation protection, such as high-quality bonds and dividend-paying stocks, that may offer more reliable strategies. An important and timely question. Thanks so much. Great questions today. As always, if you would like to send in your question, you can do so by emailing them to poollocke@poollocke.com. If you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Saving